$1,000 a month, how many little luxuries do you got to trim to make that payment? And so I think economic activity, look, the third quarter number somehow, and I think it has to do with inventories or something, is probably going to show positive. And everybody's saying, oh, the recession's over. See, I told you. I think the housing collapse over the next 9 to 12 months is going to be epic, like bad. And I think that's going to drive, I think first quarter GDP could be one for the record books, negative. I mean, it's seasonally really, really negative, but I think this year could be really, really bad. And earnings, look, the whole earnings nonsense of, Tesla, you knew I couldn't go without Tesla. Tesla lowered their earnings guidance the night before by 9%.
Yeah.
The night before. So they could beat. They lowered it from $1.09 to $1 so they could report $1.01 and quote unquote beat. And the only way they beat was because their accounts payable went up $2.8 billion. They just didn't pay their bills. So if you're a creditor, but my point is, that's not a beat. If you told me you were going to make $1, and the problem is 6 months ago, they said, oh, we're going to make $2 or whatever it was. And you lower it to $1 and you make $1.01, that's not a beat. So that nonsense, I think, is over. And I think, we're seeing it, right? With the Snap just debacle this morning. And I think there's going to be a lot of companies that have these types of debacles over that period. For 9 years, Mark Benioff went on CNBC once a quarter, the day after earnings, to explain the narrative, to explain why adjusted EBITDA and community value was so important. And the woman from IBM never went on TV. Okay. And he was just on TV again, even though they had dismal results, explaining the narrative. And people buy this stuff. And I don't understand how it's like when Adam Newman went on and talked about community adjusted EBITDA. No, Adam, you don't get to say that you spent money to build a community, but that doesn't count because it was an investment. No, that's money you spent. You don't have it now. And when you go bankrupt, which you probably should have, you can't pay it back. So the nonsense stuff of the hype machine people, I think is going to reach epic proportions over the next couple quarters. And I think people just need to be wary.
Yeah.
Innovation that's out there is extraordinary, right? The opportunity to invest in innovation is like, only one other time in the 90s around the internet. The thing I am concerned about, and we started with this, we'll end with it, that, we're at a perilous point. And if we don't hold this level, this 19 level, and we're already a little bit lower than that, there is air gap risk. And look, over the long term, that's incredibly bullish if you want to own the network. In the short term, it's going to be a whack to the narrative and to the confidence and to the join us movement, right? My socks. We need people to join us. We need people to come. Matt Hogan tweeted this morning about, we've been doing it all wrong. We've been trying to get the pension funds and the endowments and the big institutions, and we really haven't been focused on the financial advisors. And that's actually who's going to come in first, right? One of the big organizations, the Morgan Stanleys, the UBS, or somebody's finally going to flip the switch, and those financial advisors are going to get in. And then, and look, they're the smartest endowments, they've already gotten in, right? They're in Paradigm and A16Z and all that. A couple pension funds are in, but 83% of pension funds, zero. And 63% of those, no plan to change. Crazy. But I say crazy because I'm